Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Terrific you can join us here again at Ausbiz as we get across what we saw on global markets overnight. Investors losing some enthusiasm to begin the week with European shares ending in the red. This as an EU trade deal with the US looks increasingly unlikely before the August 1st deadline imposed by Donald Trump. However, on Wall Street, the S&P and the Nasdaq notched record high closes amid positive earnings results. Shares in Google parent Alphabet rallied ahead of its quarterly report on Wednesday. Tesla also reporting midweek with results from the first of the Mag 7, expected to set the tone for the other heavyweight companies. Tesla did dip on the day. Apple gained and Amazon rose, both lifting the S&P 500 and Nasdaq. Elsewhere, Verizon rallied after the telecommunications company boosted its annual profit forecast. Pizza chain operator Domino's beat analyst estimates for the second quarter of same-store sales, helped by new items on its menu. And in Europe, Stellantis said it expects a net loss of 2.3 billion euros for the first half of 25 as the car maker faced the challenge of revamping its product ranges while also dealing with the impact of US tariffs. And Ryanair shares lifted after Europe's largest low-cost carrier reported that its quarterly profit more than doubled. Well, transatlantic trade between the United States and the European Union is at risk of collapsing, according to the EU's Trade Commissioner. The EU is considering countermeasures against the United States as prospects for an acceptable trade agreement with Washington fade. Talks between the EU Trade Commissioner and his US counterparts in Washington last week failed to achieve an agreement, leading to the expectation that President Trump will follow through with his threat to impose a 30% tariff on EU exports by August 1st. Meanwhile, further doubts have been raised about the independence of the US Federal Reserve, with US Treasury Secretary Scott Bessent saying, "I think that what we need to do is examine the entire Federal Reserve institution and whether they have been successful." Well, US Treasuries have rallied, pushing yields lower as investors unwound short positions amid uncertainty over the economic fallout from US tariffs. The 10-year falling to 4.36% and the yield on the 2-year note was at 3.85%. And the US dollar index is down more than 0.5%, while the euro has risen and the yen has recovered after Japanese Prime Minister vowed to remain as leader even though his ruling coalition lost its majority in upper house elections. And the Aussie trading at 65.3 US cents. And Bitcoin is lower. It's currently at around 117,500 US dollars. Oil prices have eased with the latest European sanctions on Russian oil expected to have minimal impact on supplies. Brent crude futures at $69 a barrel. Copper's up more than 0.5%. Iron ore has surged almost 3% to $103 a tonne. And gold has gained more than 1% to hit a 5-week high as the dollar and US bond yields weaken. Spot gold just shy of $3,400 an ounce. Well, for more on global markets with a focus on European investment strategy, particularly given what's going on with the trade negotiations between the US and the EU, I caught up with Jeremy Peloso from BCR Research.
The markets right now, it seems, whether it's the European markets, equities, or even bond markets in Europe, it seems like the trade negotiations are no longer as market relevant as they used to be, which makes sense if you look at the timeline in terms of negotiations between the US and the EU since Liberation Day. We went from 20% and then it dropped back to the baseline of 10%. And then on May 23rd, President Trump threatened with a 50% of tariff. And now we're back at this stage, at this point when we're still waiting for the two economies to strike a deal. It seems very unlikely that a meaningful deal will be out before August 1st. So in terms of market implications, it's wait and see. Unless you can read President Trump's mind, it's really difficult at this point to know what will happen.
Because we've heard from the EU's chief negotiator has said that if no deal is reached by August 1st, expectations, the EU is going to impose its own countermeasures, given the 30% that we put on European exports. And as a result, transatlantic trade will essentially come to a stop.
So that's right. I've read those comments as well, Andrew, and I think if we end up with 30% tariff on import from the EU, we could see. So I don't think we would see a total collapse of trade between the US and the European Union, but it would definitely be damaging for both economies. Don't forget it. It works both ways. In terms of retaliation, we've heard about retaliation packages ever since April 2nd, but now it seems very clear to me, at least, that the EU don't want to see an escalation to the trade conflict, and so we've heard about those retaliation measures. Right now, the packages are around 100 billion euros, but nothing has been officialized just yet. So the main course is still to strike a deal. It just seems that at this point in time, Andrew, the EU have realized that there is no coming back to less than 1% on tariff. 10% baseline seems to be the best case scenario at this point in time.
So Jeremy, given that backdrop, how positive are you on European equities at the moment? I guess also given how those EU economies are tracking.
So honestly, at this point in time, I think, especially when we look at the Euro Stoxx 50, what has been hurting large cap equities in Europe isn't so much trade negotiations or the lack of negotiations. It's mostly the strength in the euro. So we've seen, especially against the US dollar, we've seen the euro having a really good first part of the year, and it's actually hurting European equities. If you look at the performance or the rally, the V-shaped recovery of the Euro Stoxx 50, it failed to reach or to make new all-time highs. And one of the reasons is that the euro is so strong. It's hurting competitivity of European companies, and it's also making it difficult for exports. And remember that the Euro area is a large exporter. So I would mostly blame it on the strength of the euro for I would say, the underperformance of European equities relative to US ones.
And as a result, you see that small caps are going to outperform the large caps. So you're overweight there. Now, why is that? You just point to the fact that they have a larger share of their revenue at home, therefore less exposed to the potential of those impact of tariffs.
Correct. So when we look at the advantages of European small caps relative to large caps, one advantage clearly is that they have a much stronger domestic bias, which means that when the euro actually strengthens, it tends to lead to an outperformance of small caps. Another added benefit, and this is very timely, is the fact that European small caps are also less exposed to trade with the US. So when you look at the breakdown of revenues by geography, you see that small caps in Europe, they derive 60 to 65% of their revenues domestically, and with a very low share of revenues coming from the US. So the way I put it is that small caps in Europe are sort of a natural hedge to trade uncertainty, which right now is starting to rise again the closer we get to August 1st.
So you're overweight small caps there. How do you regard their valuation at the moment?
Very cheap. So unlike the broader stock market in Europe, which historically is not as cheap as it used to be when you look at the 12 months forward PE, small caps they were extremely cheap. They are trading at a rather big discount relative to where they used to be 2, 3, 4, 5 years ago. So valuation wise, very cheap. And even when you looked at other technicals, such as whether they're overbought or oversold, we haven't yet reached levels that are stretched. So it seems that at the moment, small European small caps in Europe are cheaply valued, not oversold, and on top of that, you have the macroeconomic backdrop that supports them.
Are there any particular sectors you'd be focused on?
So, I mean, one of the sectors would be the real estate sector within Euro area small caps. It's actually, relative to large caps, it's actually a big overweight within the small cap index, whether you look at the FactSet or you look at the MSCI indices. And one of the reasons why I would suggest focusing on real estate is that we're still seeing interest rates falling in the Eurozone. The ECB is still expected to cut between 25 and 50 basis points for the remainder of the year. We're still seeing we're still bond bullish, and so yields falling, interest rates falling are usually supportive of outperformance of real estate equities as opposed to bank equities. And the nice sectoral breakdown between small and large cap is that small caps are overweight real estate, underweight banks, and the opposite is true for large caps. So again, that's another macro backdrop that supports the small caps.
Jeremy Peloso from BCA Research. All right, let's turn our attention to the local market. Just before we get going, we are expecting a modestly higher beginning with the SPI futures up around 12 points. Stay with us. I'll get right across that in just a couple of minutes' time.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.